Welcome to the Carbon Equity webinar. Is now a good time to invest in climate tech, where we'll be talking about investing in climate venture capital and private equity during uncertain times such as these. Before we dive in, a few household reminders. So we'll be talking about the climate dynamics, not specifically about any funds. To be clear, today is not formal investment advice. So please do not base your investment decisions based on what you hear in this webinar. Important disclaimer. Feel free, if you want, to mention your name and role in the chat to get acquainted with who else is interested in climate investing. You will find a Q&A section. In the Q&A section, you can ask your questions, and then we will try to get to all of your questions during the webinar, and if not answered during the webinar, we will get to your questions after the webinar. So we're looking forward to make it a super interactive session. Then, before we get started, a brief agenda. I'll briefly introduce carbon equity for those people who are new to carbon equity. I will introduce our fabulous speakers, Helen and Christian, who are joining us today. Then we'll dive into the panel discussion, and we'd love to have you join in the Q&A. So before I dive in, very briefly, what is carbon equity? Carbon equity is a climate venture capital and private equity fund investing platform. We seek to unlock access to the world's best climate venture capital, growth equity, and buyout funds with the goal of accelerating the climate transition. So Carbon Equity selects some of the world's best climate fund managers, amongst others 2150, and hopefully in the future also at One Ventures. Very excited about you, Helen. And then we enable low minimum access, currently starting from 100,000 euros for private investors and from 1 million for professional investors. And soon we will hope to lower those minimums even further. So carbon equity ultimately enables access to diversified climate investments through both single fund and fund of fund structures. You can learn more about that at carbonequity.com. But today we're going to be talking about climate investing itself. And so this year has been a pretty hectic year, I would say, for climate investments. And what we're going to be answering today, the question today is this a good time to invest in climate tech? And for that discussion, I am joined today by a couple of wonderful people. First of all, my co-host, Lisa Rubenstein. She is a co-founder of Carbon Equity and our Chief Impact. I am Jacqueline van den Ende. I'm the CEO of Carbon Equity and also one of the co-founders. And I am joined here by Helen Lin. She is a partner at One Ventures. And Christian Hernandez, a partner at 2150. And we're going to be talking about, is this a good time to invest in climate tech? Well, the long and short answer of this question should be, of course, it is a good time to invest in climate tech. It's always a good time to invest in climate tech, given the pressing issues that we face and the great urgency to decarbonize our economy. But that said, it's been a pretty wild year, right, for the economy and for the investment markets, especially. Both public and private markets have gone on a pretty wild ride, I would say, from a huge boom in the 2021, 2022, and then followed by a pretty big collapse of the investment markets. Climate investing has been exempted at least until 2022, but we've seen quite a slowdown now also happening in 2023. So the climate market seemed quite insulated last year. The climate investment market itself still grew 7% in 2022. Approximately 200 billion, 196 billion was invested in climate private markets last year. But in Q1, we finally saw yeah, that slowdown catch up also with private markets. And we saw a 35% year-on-year decline of capital invested in climate investment. So definitely something we're going to be addressing. The economy at large is facing significant headwinds. We've seen high inflation, we've seen higher interest rates, we've also seen some supply chain issues. And at the same time, the climate investment market is also facing or benefiting from significant tailwinds. So everybody will have read about the major government stimulus packages. We've had the IRA, the Inflation Reduction Act in the United States. We've had Europe counter with the Green Deal. We've seen China introduce an emissions trading system, which is 3 times the size of the European market. So a lot of momentum in the climate markets. So we're going to be discussing how these tailwinds balance out the headwinds, what to expect of climate investing in 2023, and how actual climate investors on the ground are dealing with these macroeconomic dynamics. So as I mentioned, Helen Lin is here. She is a partner of @One Ventures. @One Ventures is a leading and super exciting US-based climate VC fund. Helen has herself worked across 4 continents, I think Europe, Asia, US, correct? And Africa. Yes, so super all-round background. And I also read in your bio that you like puzzles. Do you mean like 1,000-piece puzzles, or do you mean more like climate challenge kind of puzzles?
All of the above.
All of the above. Okay, okay. Tell me, what's the highest number of pieces in a puzzle you've ever made?
Oh my goodness. Probably, yeah, like a 5,000-piece puzzle.
Oh my gosh, you're you're honestly an expert. Okay, okay. Wow, world record holder for puzzling. All right, Christian Hernandez is a technologist and super experienced venture capitalist. He is one of the co-founders of 2150, which is an urban tech sustainability fund, one of the coolest funds in this specific theme. Christian is a super experienced investor. He previously co-founded White Star Capital. White Star was or is still a very big fund. It was a $250 million venture capital fund. And Christian has a pretty rich background, also held several leadership roles at big technology scale-up companies such as Google and Facebook. So super rich experience coming into this climate investment market. So thank you so much for joining me today. Really excited to have you here and ask you some questions. So let's dive right in. Helen, maybe starting with you. I was just curious, like, what was your journey into climate tech? Like, what was your wake-up moment, if you will, that started your career in climate?
Well, in my past life before this was when I was in Africa, spending 8.5 years working in more social impact, actually. So I was in microfinance, providing banking services to those that are financially excluded from the banking system because they don't have an identity or enough income. I was doing that in 6 countries on the continent. And I think while you're there, it's really hard to extricate social impact and climate impact because you are working towards alleviating poverty and lifting the quality of life for, base of the pyramid customers. And while you're out there, you just see, how crucial issues like energy access, but clean energy access, right? And access to clean mobility and access to, clean cooking and all of those are inexorably tied together. And so we tried to launch a few initiatives at my old firm related to that. But, at its core, that company was a bank. And so it wasn't exactly the best equipped to be working on a lot of clean tech. And so I knew that when I moved on to my next role, that I wanted it to be something that was solely focused on climate impact.
Yeah. Would you say that you could see more devastating impacts of climate change in Africa? Could you see that? Was that more visible and more immediate than you typically see in Europe or in the United States?
I think what you see there is that, I mean, you may be familiar with this concept of climate justice, where the people who have done the least to contribute to the problem that are in the global south will be the ones who suffer the most. And right now, you maybe don't see it quite so obviously, but if you just think about, from a common sense perspective, most of the agriculture there is done by smallholder farmers, and that just kind of do subsistence farming or maybe a little bit of, commercial farming. And those are the agricultural players that are going to get impacted the worst by rising sea levels and drought and floods and have the least resources to really cope. And so I think you are going to start seeing more and more of those demographics really, really suffer and lose their livelihoods, unfortunately, very soon.
Yes, I can imagine. Christian, you come from a generalist tech background, also started at White Star Capital as a generalist VC. What was your personal journey into climate tech and your wake up moment, if you will, if you had such a specific moment that triggered you into climate?
Yeah, there's even a podcast called My Climate Journey, right? So we all had it. So mine starts in Princeton. The World Economic Forum organized an exec ed initiative at the Andlinger Center for the Environment in Princeton. And I applied, I got in, it was free, and I was climate curious. And I walked away from that freaked out, because once you start going deeper into climate, you realize driving a Tesla is not going to move the needle.
Yes.
But then also hopeful. We had a panel with these 3 entrepreneurs, all building now climate tech companies, back then green tech. And they were all frustrated. They couldn't raise their Series A. They both raised seed rounds. And these were like, one was the third engineer at Tesla. One was the former CTO of First Solar. So they were like kind of green tech royalty, and yet there wasn't enough capital for them. And so I walked out of that realizing that I could use the same tool of venture to go find these amazing entrepreneurs whose technologies, if they scaled and succeeded, could have a greater impact than another e-commerce or gaming company. And so, yeah, and then spent about a year trying to think what I call it my vector of attack, right? Where was I going to focus on that could have impact in the shorter term and actually scale out, which is why we ended up focusing on the broad urban environment.
Yeah, exactly. Because 2150 very specifically focuses on the theme of the built environment. Why for you is that like the biggest, problem to tackle?
Yeah, so it's, there's a misallocation of capital in climate tech. So PwC had this data: 50% of venture capital and private equity goes to mobility. That's only 12% of the problem in terms of emissions. 50% of the problem in terms of total emissions comes from buildings and industry. And you could argue that the majority of the world's industry is set up to feed, power, provide resources to the 1% of the inhabitable land, which is occupied by cities and half of the world's population. So we wanted to rebalance that. Secondly, it's the one place where regulation and customer choice is driving change faster. And then thirdly, is the one place where there's technologies available today that could have an impact today. And then so we bias ourselves towards what I call carbon now, like stuff that can actually be deployed now and actually start having that impact today. But at the same time, yes, we're a vertical fund, but I always joke we're the world's largest vertical.
Yeah. That's pretty all-encompassing, exactly. And one follow-up question then to that question: why would you say the building sector specifically was underinvested compared to something like mobility, which captured a lion's share of the investable capital?
Macro-wise, construction is the most laggard digitization industry other than agriculture. It's just fragmented, undigitized. So that it had that tech problem already. And then on the climate tech side, I mean, there's like solutions that look dumb on the outside, but can have massive amount of impact. We can talk about some of the portfolio companies later. And there's actually like what's driving it is also regulation. In New York, the largest carbon tax in the world is about to roll out. It's called Local Law 97, $268 per ton of CO2. Wow. That's driving a lot of landlords that wouldn't usually think about energy efficiency to look for solutions.
Yeah. Cool, exciting. Helen, what would you say is the unique thesis of At One Ventures?
So our tagline is that we catalyze a world where humanity is net positive to nature.
Mm-hmm.
And that stance, which thankfully is being adopted by more and more investors now, but puts us a little bit in the minority because basically all these terms you hear of net zero and carbon neutrality and those kinds of statements, our stance is that that is not enough.
Mm-hmm.
That when you sit down and just do the math on, we're emitting, over 50 gigatons annually of CO2e as a species, and there's like, much, much more that's already up in the atmosphere. And then you just kind of extrapolate that to see what needs to happen to meet Paris targets. It is, even if we turned all of the ongoing emissions off completely, just turned the tap off and brought all that to zero, all industry down to zero today, it's not enough.
Yeah.
And so we could all be net zero right now, and we would still experience catastrophic climate change events that would, displace billions from their homes and all that kind of unfortunate events. So we adopt a stance where you need to be net positive to nature. So you have to draw down, you have to abate, you have to do all of it. And those solutions that feel a bit incremental,
Mm-hmm.
while they are still helpful, and we don't want to be disparaging of anyone who's trying to participate in the climate fight, it's at least our thesis that if we're going to invest, that we need to invest in things that take big swings at abatement and then also draw down at very significant scale.
I love that thesis. Sorry.
Yeah, it sounds like you're taking kind of a broader view on climate. Could you give an example of a deal that maybe is not in scope if you're only focused on net zero, but that does fit your net positive strategy?
I think a lot of the drawdown, kind of element of things are much harder to invest in. So your negative carbon solutions, for example, carbon sequestration is a good example. I think that is controversial, even amongst those of us that invest in that space. You basically have technical sequestration or you have biological sequestration. Your carbon now statement a second ago, Christian, resonated because it's our view that a lot of technical sequestration is just not ready. It's just not ready for deployment today. And we keep a close eye on it, just waiting for the technology to mature to a point where it is. But right now, if you look at some of the largest deployed carbon capture plants for direct air capture, they do about the work in terms of the amount of tons of CO2 they capture in a year of about like 200 beavers. We actually sat down because
Beavers, the animals.
Yes, the animals.
Okay.
Beavers provide a lot of ecosystem services, right? They help restore peat and wetlands, and they actually do a lot. And so you could deploy 200 beavers, and that would probably capture about as much CO2 equivalent in a year as the largest direct air capture plant that is currently deployed. Wow. So those are some, just put things in perspective, right? And so the other form of sequestration is biological sequestration, which is basically like planting trees and such. So one of our contrarian views on that front is rather than invest in these huge direct air capture plants that cost hundreds of millions to build to only do the work of 200 beavers, we invested in a company called Dendra that has drones that plant trees.
Yeah.
And so part of our thesis is nature actually is largely equipped to do a lot of this work. There's an amazing graphic you can look up on YouTube from NASA. That's like a time lapse of all of the carbon dioxide emissions that go red in the winter when all the biomass on the planet dies and methanizes. Yeah. And then all of the red goes away in the summer as all the vegetation just starts to bloom and flower and grow again. So nature can do it. Even though we've done all this harm, we just need to get back on nature's side instead of fighting against nature all the time. And so our company Dendra does just that, right? Like trees are an amazing biological sequestration tool. And so if you get on nature's side and you just help plant these trees at scale with unit economics that are 10 times cheaper than they used to be, which is what Dendra does with the drones, and then you provide the AI and the monitoring to help ensure that the trees actually grow in a healthy way and don't get overtaken by weeds. That's how you can actually really accelerate, nature's own function of sequestering carbon and do carbon sequestration in a way that is much more effective and ready to deploy today. So that's one example.
Cool. I love that view, and I think it's a very important view for climate investors to always think about the counterfactual, because indeed you can set up this huge plant which then does the same work as 20 beavers or 200 beavers or 1 whale. I heard that whales are also great.
Whales are
carbon
good.
sequestration tanks. Yes. Yeah. It's always good to look at the alternative there. Cool. Let's maybe dive into the mode of the discussion, because what we're talking about is like what's happening in the broader macroeconomic environment and how that's affecting climate investors. And so my first question, Christian, would be like, are we facing more uncertainty in climate tech, or are these the regular dealings and wheelings of the economy? Should we look at this as a different period of time, or is this, regular stuff for VC investors?
Yeah, well, I mean, I think carbon equity and us started about the same time, right? At that point, climate tech wasn't yet a thing.
Yeah.
It really took off in the last 3 years. And then the amount of capital it's flowed in has been massive. Every single private equity fund has raised a 3, 5, 7 billion sustainability vehicle. You guys probably look at a dozen new climate funds per week.
Yeah.
So the amount of dry powder that's come in is significant. That was in the middle of this massive tech hype cycle the last couple of years. And there was definitely some pretty crazy pricing going on. Companies that were not going to generate revenue for a while, or that their only revenue stream was carbon offsets, at what price, I don't know, raising at like $1 billion valuation.
Yeah.
Just because. And that's definitely changed. I mean, so we keep a tracker of our version of climate tech versus general tech. We use PitchBook data just as a proxy. The late stage in climate has definitely imploded, might be too strong a word, but it's definitely collapsed more so than general tech. However, early stage climate tech has stayed pretty much slightly down, but pretty much flat, while general tech is actually down on both round sizes and valuations, which are obviously interlinked. So we think that's actually a good time to be investing into climate tech at an early stage, while the market recovers for some of these later stage rounds to happen at a more appropriate price level.
And Christian, can you explain why late stage investments have been much more affected than early stage climate VC investments?
Well, I think first of all, the IC committee of a lot of these sustainability funds is the same IC committee for the rest of their private equity strategies. And they were definitely in retrenchment mode at the beginning of the year. So it didn't matter if you were going to save the planet with that company, you were still going to get a no. Two, some more touristy investors trying to figure what was going on with the rest of the portfolio. I mean, some very large crossover funds that had pretty public implosions of their technology portfolios. And then three, if you're trying to live up to a previous hyped valuation and you went and try to raise that valuation plus, there weren't going to be many buyers. So the joke being that a lot of funds are doing extending and pretending, doing extension rounds for their own portfolio just so they don't have to write it down. So some of that was also happening. Actually, it's still happening, to be honest.
I love that phrase. Extending and pretending. All right. Yeah. No, definitely. Cool. And Helen, what do you like? I mean, there are a lot of things happening in the macroeconomic environment. There's inflation, there's interest rates, there's supply chain, there's labor shortages. What do you, as the most significant macroeconomic trend that has the most impact on climate investments?
I think in VC specifically, the thing that we've seen impact our portfolio companies the most is the extreme reluctance of investors to lead rounds. So we'll have a lot of our companies that will go out to raise and have gone out to raise in the past year or so. They'll have lots of really great investor discussions of people who love their technology and all of this and say they're really happy to invest, but as a follow-on investor. And then you just won't have very many investors who will then be willing to step up and lead the round. And so that obviously is problematic, because if you can have a 2x oversubscription on your round and follow on interest, but if you don't have a lead, you don't have a round.
Yeah.
And I think that stems really from that uncertainty in the market, where, because if you lead a round, you price it and you're the one who sets the valuation for it. And I think in times of uncertainty, what people feel is they just don't really know how to price the risk of all this uncertainty that's going on right now.
Yes.
And therefore, suddenly you have this reluctance to lead and price rounds. So I think that's probably been the most poignant thing that we've seen. And so it's been a lot of support work to try and do the research, get the data points, whether it's looking at comparables and just helping to provide very numbers driven and as objective as possible data to other investors that are trying to look at our companies, to help them set a valuation that everyone feels comfortable with and that takes in the risk of the current market conditions, but also is not completely unfair by overly diluting the company.
And so you're saying, Helen, you're still leading rounds, but you're using more data to get to those valuations. Will you say the valuations have also changed over the last 12 months? Or at least the valuation we're setting?
Oh yeah. No, valuations have come down a lot. But the thing is we're in a time of extreme swings. So 2020, everything was down because of COVID. 2021 completely overcorrected and turned into this euphoria from goodness knows where. And it was just way too frothy and valuation. It was a bubble that was always going to burst. And so now I think people have actually overcorrected from the euphoria of 21 into almost like overly negative territory. So we're just in this period of like extreme swings, and hopefully we'll calibrate to a happy medium at some point, is what we're all hoping for. But right now it does feel like a lot of companies are undervalued for the fundamentals of how advanced they are and how much they've achieved. And it really is just this overly negative market sentiment that's driving the valuations down.
How are you seeing that develop? Like you say, it's sort of like an overcorrection towards the negative side. What is your expectation of how investor sentiment in terms of climate investments will develop in the rest of 2023 and early 2024?
Well, if there's anything that I've learned, it's that my crystal ball is broken.
That is wisdom, Helen.
So at least over the past 3 years, that's what I've been proven is, my crystal ball is flawed, and I'm returning it to get my money back. So I don't know. I mean, I have some thoughts, but I thought I had some thoughts the past few years as well. Based on what we've seen, I would extrapolate that the rest of this year will continue to be very difficult for fundraising, for, early stage or late stage growth, VC stage companies. I think there's also like a knock-on effect that turns into a vicious cycle, because the less investors deploy, you start to see some startups pull back from raising.
Yeah.
So everyone's talking about the down market. So, I mean, this extending and pretending thing that Christian mentioned is quite real. If you're a startup that has the ability to do an insider round to get an interim, like $1 million, $2 million to extend your runway, and that way you just don't have to go out into these really tough markets right now to try and raise, that's probably going to be the more favorable option right now, rather than just like, this very arduous journey that is fundraising at the moment. So it just means that a lot of startups aren't even coming to the markets right now, because they're basically just kind of in this like holding pattern, trying to just wait out the storm. And so fewer companies raising, less money being deployed, but then people who are deploying just aren't seeing as many good companies, so they're not going to deploy either, and it just turns into this like vicious cycle.
Interesting. Christian, one of the big discussions is obviously interest rates and climate tech versus, let's say, software as a service type investing is known to be typically more CapEx intensive. do you have examples of how higher interest rates are potentially affecting your portfolio companies? Like, what's a real world example of a company dealing with this in real life?
Yeah, so I mean, let's talk about the climate capital stack, because for many solutions to exist, they're going to have to make atoms to replace bad atoms, or there's physical components,
Yes.
physical things that need to be rolled out. Those require this thing called capex, and definitely have lower margins than 90% plus SaaS software. So many of our companies that have a hardware component need to think about equity raising from me plus credit or debt alongside it. Obviously, if your interest rate on that debt just went up, that changes the whole kind of financial underwriting model for what you need to go build. So that's a part I'm concerned about. Also, who's lending, where there's just not enough private capital, private debt solutions for actually be it first of a kind type prototypes, or actually just asset financing. There's obviously project financing. They know how to do solar, they know how to do offshore wind, but what about this new hyper efficient air conditioning unit that's 90% more efficient, but nobody's ever seen that thing before? How do you actually figure out what the end of life value would be for it?
Yeah.
So that's I think has been challenging. I think it's gotten more challenging now with the interest rates. And the second part is actually the capital that we asked for. So our limited partners who now have other options, there's two knock-on effects. One was the denominator effect from public markets, which affected every single endowment in the US. And so they were now overweight venture. And then secondly, now you can put your money in a T-bill and pretty safely make X versus the high risk of betting on a venture capital fund where you'll also be illiquid for a long time.
Yeah, exactly.
That's definitely I'm now seeing funds start with 18-month fundraising process in their legal docs.
Yeah, wow. What are you recommending to companies such as, let's say, indeed, pretty capital intensive, radical new air conditioning technology that needs debt financing? What are you recommending them on how to navigate this higher interest environment? What can they do?
It's finding other sources of funding. So there are, for example, in the case of that specific company, NYSERDA in New York State actually has capital to deploy prototypes units, which comes in the form of a non-dilutive grant. So what other types of non-equity funding could you go find? I mean, IRA has been a boon for a lot of climate tech companies and like how it's accelerating demand. But you still need to build the thing before you can claim the credit back. There's a number of governments that actually have programs as well. There's a great program called the Breakthrough Catalyst Program. It's funded by Breakthrough Energy that actually funds the first of a kind projects that nobody else is going to fund.
Cool.
So being creative about who you go to for what type of capital.
Yeah, makes sense. And one more angle to that. Obviously, there was a high-profile collapse of Silicon Valley Bank and then First Republic Bank, and these were known to be pretty bullish on climate investing. How big is the impact of the collapse of SVB for capital-intensive climate technology companies?
Yeah, that was a fun weekend.
Pretty stressful.
It sure was.
Yeah, I mean, so the problem is not only like Silicon Valley Bank banked the vast majority of tech companies, but also their investors. Like many funds had all of their capital call money and probably the mortgage for their partners with Silicon Valley Bank. So I think that had a spooking effect on the overall industry. Yeah, I mean, Silicon Valley Bank, there's an article, I think New York Times or somewhere like that, talking about how they've been funding a lot of this project financing, asset financing. I don't know what's going to happen with SVB US in that regard, but SVB Europe at least is indicating, the UK arm, that it's doubling down on its activities. It's under HSBC. So let's hope that's the case. There's also an opportunity for others to get into it. I mean, so HSBC itself, for example, has actually has provided funding for a number of our startups. But yeah, I think it's definitely. I don't think that's dire that article made it sound, but I think it's just the same impact it had on the rest of tech. And everybody now learns about treasury management, and actually I literally just emailed the founder, how many accounts do you have now? Where's your money?
Yeah. Whole new questions that you need to think of in the VC space. Macroeconomic environments, we spoke about the headwinds, but we're also obviously benefiting from massive tailwinds, like net zero commitments from companies and corporates alike. And then for me, what is new in the past, let's say 12 months, is sort of this geopolitical competition to attract green industries, where we've seen the IRA, which was a $370 billion bill incentive in terms of tax credits and subsidies for climate technologies. And that could, it's uncapped, so it can even go up to $1 trillion. So that's a massive stimulus. And then Europe is trying to counter, and China is joining the game. So that is super interesting. And a question we've received from the audience is the competitive landscape between the US and Europe changing as a result of the IRA? Helen, what would be your view? Are we seeing more companies be attracted to the United States versus Europe? Is that having like a real impact on the competitive dynamics?
Well, it's an interesting question. I think it's also sector specific. And I also think that the in practice application of trying to get a piece of those funds can be a little bit different than just seeing the big numbers, right, that you may see in the news. There have always been certain, macro factors like that have made each region more attractive or less attractive for certain sectors. So for example, like the cost of energy, comparing between electricity on the grid and natural gas, in Europe versus in the US, like, is it a factor that is different enough where we've looked at, for example, a bunch of heat pump companies, and the economics don't work in the US simply because of fossil fuel prices in most of the states there compared to electricity, but they will work here in Europe.
So the
right, because
prices in Europe are more attractive for heat pumps, comparable.
It's more like the gas prices are higher.
Okay.
So gas is so cheap in the US, and other fossil fuels as well, because they continue to be supported in a lot of places, that to compete, to take an electrified solution like a heat pump that's going to incur charges based on electric prices.
Yeah.
And then to replace a very cheap fossil fuel price with a relatively and comparatively high electricity price, those economics just don't really work. Yeah. Right. But you come to a lot of the markets in Europe, and then the opposite, well, not quite the opposite, but it's closer, right? It's better in certain countries. And so suddenly the economics do work. So dynamics like that have existed already before, the oncoming of the IRA and such. So I think you still have to just kind of look sector by sector and look at like eligibility and things. Like we had some companies that wanted to apply for certain subsidies, but you had to go through certain certifications first, right? To like make sure you were eligible. So it's not just like, oh, there's this giant pot of money and you raise your hand and say, I'm a climate tech startup, and then you just stick your hand on, right? So it's I think there is still some of those subtle nuances that you have to take into account. Maybe in the longer term, you'll start seeing it shift focus in certain places, but right now I think people are still kind of feeling it all out on exactly what the practicalities of it are.
Yeah, exactly. Has the IRA made certain technologies more attractive in the US that were less attractive before?
I think for renewable energy, it's definitely trying to make a push. It's always that's a good example, actually, of something that is currently more attractive in Europe, which is why you see it kind of more developed here. And so I think hopefully that's what a lot of the subsidies are going to go towards, and it will make a lot of renewable energy tech a bit more attractive there. And some of it maybe can help bridge some of this valley of death that we were just talking about, right? With decreases in availability of debt and project financing, maybe it can come and fill in some of the gaps.
That would be cool.
Yeah, hopefully.
Christian, to what extent do you as an investor bank on subsidies and stimulus packages? How important is that in your decision making as an investor when deciding to invest in, let's say, capital intensive type industries?
Well, we definitely take into account, but also I also realize that politics, and especially climate, are polarizing.
Yeah.
So, there's an election coming up in the US. I don't know which way that's going to go. What implication will that have? So that the company and the technology needs to be able to stand alone without necessarily the subsidies. And maybe the subsidies are an accelerant or the incentives are an accelerant, which is definitely the case right now with some of the companies we back. But if they went away, would I still underwrite the case?
Yeah.
And the other thing that we're trying to do with our companies is provide them with, to Breakthrough does it really well because they have an army of policy people, provide them with advice on where we're seeing tailwinds for their specific solutions. So yeah, like Helen mentioned the heat pump issue. The UK has the same issue because in the UK, the gas that powers your boiler is subsidized.
Yeah.
So the cost to run heat pump is actually higher than, so the math doesn't work for the savings, even though it's magical and generates, it's super efficient. But the one thing that does work for the US is its scale. I think Helen, you also have a cement or concrete investment, I believe. So cement and concrete, 7% CO2 emissions, bad stuff. Very little innovation. 3 years ago, we invested in a company called Carbon Cure. Now a lot more coming out, which is great. If you're certified as a cement mix in the US, you pretty much have the whole country as your market. In Europe, a new additive for cement needs to get certified country by country, which is very slow and very painful. So it's Europe, but it's not really Europe.
Yeah, exactly. As a result, are you seeing a lot of like technology companies try to move to the US sooner than they would have done if they were a SaaS company to benefit from this single regulatory massive market?
They're definitely, we have a couple that have accelerated their thinking about when to go to the US.
Yeah.
One actually, it was not part of the plan for this year, and they've accelerated to actually go open up the plant there. I mean, it's not only the IRA incentive, there's also carbon CO2 tax write-off that you can integrate. There's energy efficiency. There's utility company incentives as well. So it's actually like when you start looking at it, there's a lot of different nudges at the state level, at the city level, all these cities making net zero commitments. As an example, London has claimed they're going to be net zero by 2030. That's pretty soon.
Yeah, that's very soon.
And then if you look at where carbon emissions in London come from, JLL did a survey. They claim it's the highest out of any major city in the world. It's 77% of emissions coming from the building stock, which is mostly old Victorian or pre-World War II buildings. That's a problem. What's the incentive for you to go do something about it? There doesn't exist one today. So effectively, there's all these stranded assets of buildings that can no longer be rented because they're EPC C or below after 2028. That nobody's doing anything about, like millions of square meters of building stock.
Yeah, cool.
There's one, I think, final angle to IRA that might be worth mentioning. It's a question came from the audience. So in IRA, there's a specific provision that a lot of the technology needs to be produced at least partially on US soil in order to be able to be eligible for the tax benefit. Have you seen production shifts or thinking about where to build plants?
I think they changed it, right? The EU lobbied for it to say the US or a trade partner. I don't know if that's final or not, but that was the discussion at least. Yeah, I mean, if you have a battery powered solution, we have one that those batteries are probably coming from China today. How is that going to get treated in the US? So where do you go find a US battery supplier that can be price competitive with that Chinese option? Yeah. That's where it breaks down. So therefore, now you're going to create a fake price premium on that for it to be locally sourced. Mm-hmm. Yeah. So that completely changes the unit economics of each of those systems. So that we haven't yet validated whether demand exists at the higher price point because of the incentives. Because it's definitely, and then is there enough supply of batteries? So I think the IRA incentive is there. The supply chain hasn't caught up.
Yeah, interesting. Another angle to this, so we've seen this macroeconomic environment changing, both with certain headwinds, certain tailwinds. How has that changed, I think, for both your funds? How are you looking at specific technologies? What technologies or business models have become more attractive, and which ones have become harder to invest? Maybe Helen, you want to take it first?
Sure. So, we always try to be very fundamentals driven, to really just focus on what we call physics or science first and finance first fundamentals, and physics just being it's mass and energy balances, matter and energy moving through space and time is how we define it on our team. So if something, for example, inherently just uses fewer kilowatt hours of energy to do a thing, that's a fundamental energy win that can bring down the techno-economics, bring down the cost, and therefore should drive adoption and scale. If something inherently uses a lower mass of chemicals to get something done, right? Same kind of thing. And so or it has a higher throughput, so it gets stuff done in like a shorter amount of time, more done in shorter time. So those are the fundamentals we typically focus on. And if we satisfy ourselves that those techno-economic wins are still there, then it's fundamentally still a very strong and compelling technology. And so, we're not going to let the market conditions stop us from investing in something where we believe in the fundamentals. Where we have started to be a little bit more cautious is because we see the rest of the market is being driven towards this kind of extreme level of reluctance and caution right now. Is you can be the best company with the best technology in the world, but if you can't get funded, you're not going to survive. And so I think we're being extra detail oriented on looking through the business model and the financial forecast of the company. How much runway do you need? How much extra runway are you going to need to get to your milestones to be able to successfully raise and capitalize at the next round? Because you really just cannot assume or count on that next round just being a given that it's going to get raised with any kind of certainty at the moment. And so if we really, at the point at which we decide to invest, we sit down with the company and do a very careful exercise to make sure they're raising enough. And then we often have minimum funding requirements now where we won't fund our investment unless that minimum total amount for the round gets funded so that our capital doesn't get stranded if we put our money in and then they don't fill the round, which unfortunately makes it a little bit harder for the companies sometimes, but it's a risk mitigation measure that I think you do have to take.
I can imagine. Christian, one thing I'd love to know from you is kind of like, what technologies have you seen develop more quickly than you expected, scale up, come down in cost, and which ones are maybe slower in their acceleration?
Yeah, well, I think Helen already alluded to DAC as a holy grail that has yet to get proven, with a lot of money that's gone into it, right? So like linking this to your previous question, I have two brains. One brain in me is like the failed scientist, geeky guy that actually loves to look at like deep tech stuff that someone's going to take some time to properly scale. On the other side is like the practical brain that just focuses on something that looks unsexy, but actually has material impact today. So we have a company in the portfolio called AeroSeal. I mean, I love these guys. Actually, I really love these guys, but their logo literally looks like it's from 1999 clip art.
Yeah,
it started as deep tech. It's a proprietary chemical that got developed at UC Davis that they commercialized that actually seals a building from the inside, and it works through the third-party distributors to show up at your house or your building or your factory. But that is a very low-cost way to increase the energy efficiency of your average building by 40%.
Mm-hmm.
I mean, like, it works. It's actually generating a significant amount of revenues. It's scaled out. It's been deployed across the US, but also Europe, Asia, different markets. So we're about to announce, I can't talk much detail about it, this deal that I just fell in love with. It looks simple, but it's actually got a bunch of pans behind it, and it helps to decarbonize some of the hardest to decarbonize buildings. And it does so with a simple, low-cost solution that has massive amounts of impact. I will proudly say in the blog post when it goes out that nobody was bidding against me, because I love that. I love the fact that actually I felt I had enough conviction in the deal to push for it internally, and not have to depend on, well, who else that's going to be on the cap table.
Hmm.
Yeah, super awesome.
Yeah.
Cool. Let's speak a little bit about valuations. We touched slightly on it before, but valuation, a lot of capital has come into the climate scene. Valuations in the climate market have been at a premium compared to the general private equity market. What are we, first of all, Helen, do you find these premium valuations, are these warranted? And if so, what are the reasons why climate investments should command premium valuations? And secondly, what are you seeing in terms of how these valuations are currently developing?
I wouldn't say the valuations at the moment feel very premium. They actually feel quite low across the board. And I mean, maybe just to clarify, so we do a lot of hardware investing. I think, Christian, similar to you guys, with just the view that like we're trying to solve a physical problem and you need physical solutions to solve a physical problem. And I think for hardware especially, the valuations are not high right now. Because there is a general nervousness about the capital intensive nature of hardware. I think the things we try to balance are what I mentioned earlier in terms of the size of the round. So are you raising enough to be able to do what you need to do and hit your milestones to be able to raise the next round? And then based on that, what is the dilution that the founders in the company are going to suffer, with your valuation? Because we definitely want the founders to continue to be incentivized, to be really excited to drive the future and the growth of the company. And if they're overly diluted, then you could see how that could be really demotivating for them. And so there's this kind of natural tension there that you're trying to strike a balance between. And then the third point of tension, of course, being our own financial interest of, hey, if the market's really down, it's going to continue to be down for the next round, we really cannot afford to get in at too high of a valuation as our entry valuation. Otherwise, the math just doesn't work for our returns in subsequent rounds and in the exit later on. And so it is a very delicate balance to strike amidst three inherently kind of opposing direction things. But we do our best to kind of find that optimum between them.
Cool. Christian, what are you seeing in terms of valuations? You're obviously in a specific niche, investing both in Europe and the US. Like, what have you observed there in terms of expectations, also with founders?
Some founders that started raising before, I don't know, it's called beginning a year, definitely went to market with expectations that are not being matched by what capital is on offer. And some are revisiting their plans, others are sticking to their guns and taking a long time to raise. There's still some weird stuff happening in the market where some stuff that's not yet generating any revenue actually is raising at pretty high valuations. So I joked with one of my founders the other day that the bad thing for him, for his valuation expectation, is that you're making money. So somebody can actually look at your trajectory and your acquisition costs and unit economics and extrapolate from that, compared to something that's promising to do something in the future, but has no data to prove it. I mean, those are happening a lot less, but there's still some weird examples out there. I think the other thing that's happening is like Helen alluded to earlier, like the business plan changes that need to be put in place to give yourself 6-12 more months, whether that's raising internal capital or not. That's also going to impact your growth rate, which is also likely going to impact your valuation in the next round, even if things normalize by next year.
True.
So how do you fight both, right? How do you get encouragement to keep on growing, but be cash prudent and maybe even, God forbid, profitable?
Yeah, exactly. Yeah. Generally, the consensus, or at least a lot of experienced investors would say, well, this is a good time to invest because asset prices are low, valuations are coming down, are starting to be more realistic. At the same time, it would seem to be a worse exit market. What are you seeing in terms of exit dynamics, Helen?
Well, we're 3 years into our fund life, so we're not really big on exits at the moment. But in general, I think that there's, you can sell anything for the right price. And so if people are trying to exit right now, they probably could, but probably for a much lower value than they would be hoping for. I just don't really see exit being a great idea for the next like year or so if people don't really need to. It definitely feels like most people are just kind of riding things out for the rest of this year and then maybe trying to explore a hopefully better market next year.
Yes, exactly. Might that affect fund lifetimes, Christian? Do you see that this could sort of stretch fund lifetimes? Is one of the questions from our audience.
Well, I mean, fund life is 10 plus 1 plus 1.
Yeah.
So my strong belief and the reason why I'm excited about this is that in the life of the 2150 first fund, which would finish in 2031, these assets that help to decarbonize the hardest to decarbonize industries will carry a price premium. Right. So all these cement companies making net zero commitments, I'm sorry, but I have no idea how they even get there without some change in the product that they make.
Yeah.
I do think that's going to lead to acquisitions of technologies and solutions, hopefully some of which we have backed, that help them to decarbonize. And that, I mean, 1, 2, as we get closer to 2030 and we realize we're not hitting our emissions reduction goals, unfortunately, bad stuff starts happening more frequently.
Yeah.
And will that drive an acceleration of deployment of some of these solutions, therefore revenue, therefore impact? Hopefully it won't be too late, but I think that those are going to be two potential cycles within this fund lifetime.
Yes.
Yeah.
Makes sense.
Yeah. We're almost at time. I think as a wrap up, we'd love to understand for our audience who are listening in, like how does all of this affect whether now is a good time to invest in climate tech, and what considerations would you tell them to look at before making that decision? Helen, maybe you want to take it first.
Yeah. So when valuations are down, it's a good time to get in from a mathematical perspective. So if you do still find a good, strong fundamentals company and you do still have to do really good, strong diligence to determine that, then it's absolutely a great time to get in for cheap. And that certainly helps with de-risking your financial return to a certain extent. The other thing I'll say is in tough economic times, there tends to be a dynamic where a lot of investors take like a flight to safety. It's kind of like how a lot of individuals will start buying gold, which I'm not going to say is a rational thing, but it is a thing that you see start happening in times of recession. So the more a company makes itself look like a brick of gold, basically, and I mean, in terms of like something that, for example, maybe in more startup terms, if you have more inelastic demand for your product, right? Or you have something that is not considered to be a luxury or a discretionary thing, but is something that really is just like crucial to life, then that, hopefully also contributes to something just feeling like a more stable and necessary play. I think that is something a lot of climate tech has going for it, is a lot of the solutions and technologies are trying to create sustainable versions of things that are actually just like fundamental pieces of society and life, right? It's energy and transportation and the homes that we live in and the food that we eat and these are really fundamental things.
Yeah.
It isn't just like, oh, some fun gamified app to like make you look prettier or whatever, So yeah, brick of gold.
Yeah, Christine, I think you already shared a similar view, but do you have anything else to add on? Is now a good time to invest or what to consider?
Yeah, well, the father of three in me says absolutely, right? I mean, this is literally a retransformation of the global economy. I mean, that's not me saying that, it's like Larry Fink saying that. And climate is not a vertical. Climate goes across everything. So yes, I think it's a massive opportunity to rethink how we make stuff, how we deliver stuff, how we use stuff, how we recycle and use it again. And so the opportunity is vast. The tailwinds are there from both a regulation, but also a customer choice, both B2B and B2C. And then the technologies some of them have been there for a while and they're not getting scaled out. Some of the stuff we see coming out of labs is like truly fascinating. We have a company that makes cement out of bacteria, like literally naturally occurring bacteria that happens to secrete calcium carbonate. They've just found a way to turn that into bricks. The way in which we can tap into biology rather than petrochemicals to make the stuff that we need. And then the final point is like why I'm not scared of hardware. Hardware actually has an intrinsic stickiness, right? Once you put the thing in the ground or on top of the building or in the plant, it's pretty hard to take out the thing. So there is a long-term stickiness to it that doesn't necessarily come from a piece of software, but you have to pay for the thing before it got installed.
Yeah. Cool. We have spoken for exactly 1 hour. It's 4 p.m. sharp. I would like to thank you so much, Helen and Christian. I think we could have continued for hours, and we'd love to have you on future shows of Carbon Equity. For now, thank you so much for being here and answering questions. We received quite a lot of questions that were not yet answered, so we'll try to get back to you by email. If you would like to know more about carbon equity, check out carbonequity.com, link with us on LinkedIn, and learn more about carbon equity, our climate funds, and investing in funds like @1 and 2150 through carbon equity vehicles. Yeah, so much exciting stuff happening. Thank you again, and we will be in touch, and we will share a recording of this webinar through email, so stay posted. Thank you all for being here.